the big number, which of course is big in my book and nobody else pays any attention to it, given all the talk about tariffs, this should be a number that everybody should be paying attention to. And that is the merchandise trade deficit, or the goods trade deficit, because these are the goods that are going to be the subject to tariffs. So we got the December merchandise trade deficit, and the expectation was for a $105.5 billion deficit, which would have been one of the worst monthly trade deficits in U.S. history. And that would have followed the $102.9 billion deficit, which was also one of the very worst deficits in history from the prior month in November. Now, that number was revised up or down, right? Because it's always down. It's a negative number, but a bigger number, which is worse. And that was revised to $103.5 billion deficit. But the deficit for December came out at a shocking $122.1 billion in 1 month. This shatters the record from March of 2022, and that followed the COVID reopening. See, prior to that, all the goods were just piling up, on the docks because we couldn't operate the boats to ship them over and unload them because everybody was quarantined because of COVID. But we finally reopened the economy, and that backlog of goods came in, and that resulted in a $120 billion deficit, which up until December of last year was the worst monthly deficit ever. And of course, it was an outlier because of the exogenous events. But now, without any of those events, we took it out. So it's not like a one-off thing. This is a disaster of a number, which should have sent shockwaves through the foreign exchange markets, but no one cares. When I used to trade foreign currencies, in the 1980s and early 1990s, this was the most important number that would come out, which would be the trade deficit. And if it was worse than expected, the dollar would get killed. I remember the Japanese yen sometimes could be up 200-300 ticks. The Swiss franc could be up 100-150 ticks on a bad trade deficit. Conversely, if it was a good trade deficit, the dollar would spike. Now no one cares. In fact, I've never seen a trade deficit this much worse than expected. I mean, it's like 15% bigger than expected. It's crazy how bad it was. Now, some people might think, look, Peter, this is probably an aberration because, companies are trying to load up on stuff before the tariffs hit. And there may be some truth to that. Maybe companies are trying to get these goods in before they're subject to tariffs, so they, either can make more money selling them or not have to raise the prices right away. But then if you look at the numbers, that's not it, because imports were up by 3.9%. I mean, that's a big number, but it's not crazy big. It's the exports. Exports went down by 4.5%. So there's an even bigger drop in exports than there was an increase in imports. You can't explain that in any way by trying to front run the tariffs, because the tariffs aren't going in the other direction. Unless you think that in fact, if our trading partners were worried about retaliatory tariffs, they would try to import more of our stuff before their government slapped tariffs on us. But that didn't happen that way. Our exports went down. And I think, again, that's evidence of a very weak U.S. economy, manufacturing economy that is in recession, that is incapable of producing these goods. Also, if you look at the December inventory numbers that came out also this morning, inventory on a wholesale level for December was expected to rise 0.3%. Instead, it went down by 0.5%. That's a big drop in wholesale inventories. By the way, retail inventories also went down 0.3. They were expected to stay unchanged. But if companies are trying to front run the tariffs by importing a lot of stuff, wouldn't their inventory go up? But their inventory went down. So it doesn't necessarily make sense that these companies are loading up on inventory when their inventory went down. And as a result, by the way, of these two numbers, the big trade deficit and the drop in inventories, the Atlanta Fed GDP now, which has its estimate for Q4 GDP, slashed their number from 3.2 down to 2.3. That is a big move for one adjustment. They normally don't move that much. So that is a big, decline in what the growth rate is. And of course, again, I think we're in a recession. I think these numbers don't really mean anything. I mean, I think the polls were a lot more meaningful. That's why Donald Trump was elected president, because we were in a recession that the statistics didn't actually validate or acknowledge. But getting back to this trade deficit, not only does it evidence a very weak economy, but it shows you how dependent we are now on the largesse of the rest of the world, and how the U.S. dollar's reserve status has never provided a bigger crutch to the U.S. economy, because the only reason we're able to run these huge trade deficits is because the world will take our dollars in exchange for all these goods. And without all these goods, our economy would implode, because we have no ability to produce these goods on our own. And it also shows you how painful the tariffs would be if they are in fact enacted, because we depend more on these foreign goods. We import more goods than ever before. And now Trump is talking about adding to the price of those goods by imposing tariffs. So if we've never been more dependent on foreign goods, then tariffs will never be more painful for Americans than they would be right now.